Hey, welcome back to Compounding Quietly. Most investors who compare SCHD and DGRO are already asking the wrong question. Not which one performs better. Which one fits the stage you are actually in right now? That distinction is where most of these decisions quietly go wrong. Let's think through this together. When SCHD and DGRO come up in the same conversation, it usually sounds like this. SCHD has a higher yield. Shouldn't I just go with that? Or DGRO grows its dividend faster, so maybe it wins over time. Both of those observations are accurate. Neither of them is the right starting point. The reason this comparison keeps repeating is not because investors lack information. Most people can look up the yield, the growth rate, and the expense ratio in under a minute. The confusion is about what those numbers should mean for their specific situation. Yield, dividend growth rate, holdings count, sector weight. None of those figures answer the core question on their own. They are inputs to a judgment. They are not the judgment itself. And that is a more important distinction than it sounds. When investors treat the data as the answer, rather than the input, they end up making choices that feel justified on paper. But those choices often do not match their actual timeline or income needs. They pick the higher yield because it looks like more money, or they pick the faster grower because it sounds like a smarter move. But neither of those is a framework. It is a preference dressed up as a strategy. Here is what sits underneath this comparison. SCHD gives you more income right now. DGRO gives you more income growth over time. Those are not the same objective. And which one you need depends on one thing: how soon you need this income stream to actually do something for your financial life. If you are in the accumulation phase still, years away from needing dividends to cover expenses, the starting yield is almost irrelevant. What matters is what the yield becomes on your cost basis a decade from now. If you are approaching the distribution phase or already in it, the growth timeline works differently. Waiting for dividend growth to close the yield gap may not align with what your finances actually need. That is why this comparison does not have a universal answer. It has a personal one, and that personal answer requires being honest about where you actually are in the journey. Let's look at how these two ETFs are actually structured. Not to pick a winner, but to understand what each one is, built to do, and for whom. SCHD, the Schwab U.S. Dividend Equity ETF, screens for companies that have paid dividends consistently for at least 10 years. Beyond that, it filters on financial quality, cash flow relative to total debt, return on equity, dividend yield, and 5-year dividend growth rate. What comes out of that screen is a concentrated portfolio of roughly 100 stocks, tilted toward financially stable, value-oriented companies. SCHD is not designed to find the fastest-growing dividend payers. It is designed to find the most reliable ones and attach a meaningful yield to that reliability. DGRO, the iShares Core Dividend Growth ETF, starts from a different question. It selects companies that have grown their dividend for at least 5 consecutive years. It also applies a payout ratio, filter to exclude companies paying out an unsustainably large share of their earnings. The intent is to find companies that still have room to grow the dividend. Companies that are already paying out a high share of earnings have less room to raise it further. The result is a broader portfolio of roughly 400 to 500 stocks. That breadth brings more even sector exposure and a lower starting yield than SCHD. That yield difference is not a flaw. It is the design. When a company pays out less of its earnings today, it typically retains more capital to grow, and that growth can eventually show up as a significantly higher dividend over a long holding period. This is where the concept of yield on cost becomes essential. To understanding the comparison, SCHD might start at a yield of around 3.5% to 4%. DGRO might start closer to 2.5%. Those numbers look straightforward in year one. But the question is not what the yield is today. The question is what the income stream looks like on your original cost basis after 10 years of dividend compounding. Here is a scenario worth sitting with. Imagine someone roughly 10 years from the point where they need their portfolio to generate income. They begin building a dividend position today and choose SCHD. From day one, they are collecting a higher income stream. That stream grows steadily, not explosively, but reliably over the following decade. When the time comes to start drawing on dividends, the income level is already working. It does not need to catch up to anything. Now imagine the same investor choosing DGRO instead. They accept a lower starting yield. The reasoning is that DGRO's dividend growth rate will eventually deliver a higher income level on the same cost basis. That reasoning can hold, but it requires the growth rate advantage to persist over the full holding period. And it requires the investor to not need that income during the years. When DGRO's yield still runs below what SCHD was already paying, the investor who switches midway through, usually, because the lower starting yield starts to feel like a mistake, loses both paths. They gave up SCHD's current income, and they cut short DGRO's growth runway before it had time to compound. Neither path is wrong when followed with clarity. Both paths fail when followed with doubt. Coming back to the original question, SCHD or DGRO, the answer is not about trailing returns. It is not about which one had a better 5-year chart. It is about which income timeline matches yours. When does the income need to start working? How many years do you have for dividend growth to close the yield gap? That is the frame the comparison fits inside. One structural difference also worth noting. SCHD's concentration around 100 holdings means sector tilts carry real weight. Financials and consumer staples have historically been significant in SCHD. That is not a problem for investors who trust the quality screen, but it is a source of variation from the broader market that accumulation phase investors should understand. DGRO's larger, more diversified portfolio reduces that concentration. For investors who want broader market exposure alongside dividend growth, DGRO's structure delivers that, without requiring a separate position. This comparison does not resolve into a verdict. It resolves into a clearer question, pointed back at you. Are you in a phase where dividend growth over time is the primary objective? If yes, DGRO's structure fits that. The lower starting yield is not a cost. It is the price of the growth rate you are acquiring. Are you in a phase where income level and income reliability matter more than growth trajectory? If yes, SCHD's quality screen and higher yield fit that. The concentration is not a concern. It is the product of a deliberate quality filter. If you are genuinely unsure, that uncertainty is useful information. It means you have not yet decided what phase you are in, and that decision needs to come before the ETF comparison, not after it. Here is what typically happens when investors skip that step. They build a position based on the data that seemed most compelling in the moment. Then they feel uncertain when the other ETF has a stronger quarter. Then they adjust, and now they own pieces of both without a clear framework for either. The portfolio reflects the indecision, not the plan. That is not a product problem. It is a framework problem. Get the framework right. The comparison becomes clear from there. The market will not tell you which one to pick. Your income timeline will. Get that part clear, and the comparison answers itself. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.